So we had a request from the Flash Investor. Follow Flash Investor on Twitter, at the very least, because there's some really interesting stuff on that feed. To have a chat about Dunhelm. Dunhelm, for those of you who are not watching or listening in the UK, is basically a home and garden furnishings retailer. Has around 175 stores all over the company, and also an online presence where it sells things out of its distribution centres. Steve, how many distribution centres do you reckon Dunhelm has?
God, I wouldn't go for many. 2.
Good idea. Oh, nearly.
1.
Correct. Yes, it sells things out of one distribution centre. It sells all kinds of home furnishing things, from mugs through to garden furniture, through to curtains, through to storage things and all these kinds of things. If it sounds a lot like IKEA, then it is a lot like IKEA as far as I can tell. So this is obviously, as far as I can see, the height of non-essential retail. Non-essential being defined in kind of COVID terms here. So when you have a pandemic and a lockdown, this is one of the first things to close and one of the last things to open. We're hoping that's not going to happen again, but it does go some way to explaining what their business has been doing over the last few years, which was getting shuttered and trying to sell things online. So it held up pretty well in the pandemic, given it was shuttered. Its revenues went down and so on, but this isn't a company that's massively operationally leveraged. So what I mean by that is, as their kind of revenues went down, their costs went down with them fairly well, which meant that it wasn't like a kind of airline where everything went to hell in a handbasket. Sure, things went down, but they've started coming back quite nicely, and the company's in kind of okay shape. They've had some modest dilution, they've had some very modest debt raising. You would expect it to be in a worse position having been closed for a bit, but actually I think it's proved to be reasonably well resilient. Does this business have a moat, then, is the question. Maybe is my answer to that. I'm not super certain I think this has that much of a moat. I don't think there's anything much going by the way of brand loyalty. IKEA is almost ubiquitous in this field from what I can see of it, and Dunhelm is very much a kind of localised version of that sort of thing. It's a retailer, and it's a non-essential retailer. Steve, what do you think a good gross margin for a home furnishings retailer might be?
It's going to be, I would imagine it's not going to be particularly high.
You would, wouldn't you? But
go on.
Higher than you're thinking, I would guess. It's about 50%.
Okay.
Which is not bad for a gross margin. Double-digit operating margins, so close to 10 or so. You've seen worse in retail space here, so I wonder whether there's a kind of some sort of... And since I don't think there's much going by way of brand power, that makes it seem to me like they have their production costs pretty well under control. Because if you think this is a commoditised business and no one really cares whether you get a Dunhelm bath mat or an Argos bath mat or an IKEA bath mat... they don't sell meatballs in Dunhelm, actually, so maybe there's an edge for IKEA. But what you might well find is that it comes down to cost, and they've got a reasonable kind of ability to make a decent margin there, from what I can see of it. Let's get to the risks then. Here's the kind of things that I find risky about this stock. We spoke a couple of weeks ago, Steve and I, about a company called Target, which is a US retailer, which was talking about having too much inventory, especially in the garden furnishing section. Dunhelm's inventory looks like it's going high, and their management has warned that they think it's quite high and that there's inflation coming through and that things are slowing down. And if you've heard this story before from us quite recently, I couldn't help but think I was seeing a sort of similar theme coming through on this. I'm not saying it's their fault. I'm not saying they're a bad business for it by any means, but I do worry about people's spending slowing down and Dunhelm finding itself with a load of stuff it's going to sit on the shelves for a little while. What will happen? I don't think they're going to have a massive fire sale and get rid of it, for what it's worth. I think it will just sit there, but that will cause things like accounting write-downs, as accountants say, no, we're not giving you full value for this lawn furniture because we don't think you can sell it full value for lawn furniture, at least not within a year anyway. Management says they have stuff for every budget, so they will cope fairly well in inflation. I think that sounds optimistic. To me, this sounds like one of the first things that goes when, or at least you start downgrading. And I think the people that might downgrade into Dunhelm are probably not going to be that badly hit by inflation. If you have a house with many, many fancy things in, like Steve does, then you probably aren't downgrading yourself into Dunhelm. If you have a house full of cheap things, like I do, you probably can't afford Dunhelm stuff anymore. My house is in a more expensive part of the world. I don't own it, though. Steve, any thoughts on kind of economy and risk and stuff for Dunhelm here?
I think the primary risk for Dunhelm is that it's going to suffer in pretty much the same way that the sort of techie sort of companies have, in that it's had some of its growth pulled forward, some of its demand pulled forward. There was a period, obviously, during COVID where people were working from home and they were looking around their house thinking, this rug's shit, these curtains let light through, blah, blah, blah. And Dunhelm would have been the places that these people visit to go and get these things, to get rugs, to get curtains, to get those kind of pillows and soft furnishings and do-it rooms and general home furnishing. And the issue being now is that we're seeing a cost of living squeeze. The vast majority of these jobs have been done. Extensions and house building are likely to have been done, and they are starting to slow. Being in the industry, I see it. So I think that's an issue for Dunhelm. I just don't think there's going to be the demand. And as you say, if inventory is rising, that's already a sign that there just isn't the demand. So for me, it's a straight no.
Yeah, inventory is rising. I mean, there's been some fairly impressive revenue pushing along. The question, as you say, is how much of that's pulled forward and how much of that becomes sustainable. I guess we will see. It doesn't look to me... I was surprised by its growth numbers, put it that way. I was pleasantly surprised by them. I thought that's actually a reasonable effort for an organisation of this type. And I don't think the stock is super expensive either. There's some debt kicking in there and not a huge amount of it. But it's trading at around 10 times earnings, which is not giant. I know it's based in the UK, but it's I think it's FTSE 250. But that's not terrible to my mind, as it doesn't seem to be in huge trouble financially or anything of the sort. I will conclude with a complete Paul stock analysis. Fastgraphs doesn't have a line on it because they don't pull data for that FTSE 250 thing, so I can't tell you whether it's above or below the line because I can't be bothered to plot them by hand anyway. And it pays a dividend of around 5%, which is, I don't know, is that interesting? Probably. Even in a rising interest rate, if you're the kind of person who likes dividends, I would give this a look if I were a dividend hunter. I am not, but if I were, I'd be interested, I think.
I guess that's the point, isn't it? The point is that we always say with these companies that have a decent dividend, if you think they can weather the storm, and it would take talented management to, get through this, and somebody with a good eye on the supply chain and customer demand, if they can get through this period unscathed and can continue to pay the dividend, you don't need a lot of growth from this company to satisfy the share price increase and to get yourself a good return. Whether or not they will do this that's the bet you're making essentially when you invest in this company. And I mean, for me, it's not something that I would pick, but I can see the attraction for people.
It might be that I've missed something fairly glaring on all of this by not looking at the news carefully enough around Dunhelm. Do let me know if that's the case, and apologies if I have. But a kind of fairly standard analysis of this, and I'm not pretending there's anything particularly deep and insightful based on this, just kind of my and your fairly instinctive thoughts with a little bit of looking. It's in a sector I like at the moment. I do like the idea of the cyclical stuff because I think people are panicking about them, and you may well find something decent getting thrown out along with some stuff that is going to endure some short-term headwinds. And I mean short-term at the business level, not just short-term at the stock level. I mean, there may well be earnings come down in this sort of thing, but at 10 times earnings, you can probably take a bit of an earnings hit if you think that cycle's going to come back and you think this company is fairly strong. I think where I'm looking at the moment tends to be for stuff that is less cyclical than people think it is. So for things that are getting cast off, where I think I don't see the demand slowing in quite that way, which is why I talked about Games Workshop before. I think that's going to be an interesting test case for that stock. We will see exactly how much people really care about that. We will also see how much they care about their home furnishings, I guess.